Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. I'm going to go through some comments on YouTube. I'm just going to respond to those comments. I'm going to give you a little glimpse into maybe some of the analysis that I do on the website for the community and the members that we've got. We also have a Discord channel and all that other stuff. So I want to address these comments. It will help you guys kind of figure out how I'm doing some of this. I'm not going to get into the nitty gritty like I do on the website and what I share with all the members there. I just went through a training session this past Saturday where I dove into kind of my strategies and exactly how I do it. My 5-year average return at the beginning of 2024 was 41% per annum for the past 5 years. So I'm averaging 41%, and I think I could better that even if I refine my approach even more so. I think I can continue to go up, and a lot of that is also subject to the market conditions. So there'll be years where I may fluctuate or go sideways, and then I'll have really, really big years. 2020 and 2021, maybe even 2022, there were some companies that went up a lot. So we came from very depressed levels. I invested when there was a lot of fear in the market. In 2020, a lot of people were doubting oil. Specifically in the September, October, November timeframe, I went very heavy into a lot of oil names that possessed certain characteristics that I look for, and I went into those with a little bit of an overweight. And yes, there is some luck involved in choosing these companies and getting 20, 30 times your money in a few years time frame. So I want to dive in. I'm going to read a couple of comments, and I'm just going to comment on those comments a little bit and give my opinions. So here's the comments. I'm just going to dive in a little bit here. So it says, best thing to do is buy when shares are thoroughly depressed. I wish it were that simple. Why are the shares depressed? Anyone else concerned about a bankruptcy in that situation? Um, yes and no. So I want to answer this kind of right head on. So I studied the markets for 10 years, right? And I was missing a piece that I just didn't find till later. Later being like 2016, 2017, is when I kind of found out something that I was missing, and it deals with the real estate cycle. And it was a guy on YouTube, Alan Kendall, is his name. I think he still has some things there. I just saw one clip, and it just kind of like clicked the last puzzle in place that I could start to research into, because I was focusing a lot on the financial side, and the real estate side is really what drives it, in my opinion. So you can tell when shares are thoroughly depressed, given the three pillars that I created. I deem these three pillars as a necessity for a long-term investor playing these cycles. So market conditions is one of the pillars. That is the real estate cycle. And you can kind of identify where you're at in some of these cycles using other pillars that I created. And that's why I created these pillars. Market conditions is tell you kind of, it's like this big, gigantic roadmap of kind of where you're at in the cycles. And you can tell where you're at in the cycle based off of assets performance against each other. So when I looked at it, you can tell that there's big long-term cycles, and then there's shorter-term cycles. Real estate is the shorter-term cycle, and then there's like Kondratiev waves, credit cycles that are big, longer cycles, debt cycles and stuff like that. The technical analysis, I needed that, and that is another pillar because I needed a way to cut through all the BS. So there's a lot of narratives, there's a lot of data that people try to sift through and then prescribe a narrative to it. So, there's people looking at real estate, and they're saying like, oh, we're in this huge bubble. And it's like, really? We're in a bubble here? Then where's the inventory? Now, the inventory could come in the future. And I would then say, given 8 months plus of inventory, that we are in a bubble. And that's when I would switch. But you have to kind of know when that bubble occurs. And then you've got about 12 to 18 months after that. So you have to kind of go in and look at all the data and study kind of how these assets perform, what's leading indicators, what's lagging indicators, and just dive into it. I don't think the majority of people really know what the heck's going on, and I dove way into it. So I was looking at all these things and how they correlate, looking at the data, looking at charts, doing all these things. And technical analysis, one of the pillars that I rely very heavily on, because what I'm doing is I'm tracking not what people are saying, but how they are positioning money. So the positioning of money is a vote in the market, and you can see that through charting. And you can see how these assets kind of rotate through these cycles, going up and then cycling down. And then other sets of assets during that same time frame go up while so technology will go up, commodities will go down. So commodities will crash, and then technology will go up in a recovery phase of real estate. And then when you get into an expansion phase, that's when commodities start to take off. And then you can see if you plot this asset versus this asset, which is a ratio, which is a pillar of what I also created, is you can see the cycles and the conditions change through these ratios using technical analysis. It's really a really insanely good system. So my strategies were to play the real estate cycle and then be aware of the longer term cycle that's also a tailwind behind you. So if you're in, for example, a longer term cycle, just to give you an example, is interest rates going up or interest rates going down on a big long term basis? From 1981, it was a peak in interest rates, and we went all the way down to the bottom of 2020, 2021, where it bottomed and started to turn back up. A 40-year downtrend in interest rates. That is a huge tailwind behind bonds and stocks. We've broken that downtrend of the 40-year downtrend to an uptrend in interest rates. And now people are going to start to realize that bonds are probably not a good investment and that stocks may be impacted by an increasing interest rate environment as well. So those things that I describe right there are the market conditions. That's one of the pillars that I look at. And I'm trying to see, am I investing into the wind with a headwind, or am I investing with a big tailwind behind me? I want all of my investments to have a tailwind behind it. And I want things to be underinvested. I don't want people to be in it. I want them to be depressed. That is how you make a lot of money in the market. You don't make a lot of money by chasing things. And that also, in my opinion, is it's a clue to me that you haven't looked at the markets deep enough. Because you can kind of know who's really good at investing and you can know who's not that good. The guys who are really, really good, the guys who make this basically their profession or they live off their investments, they adopt the same strategies that I do. They're patient. They buy when it's super low, and they get multi-baggers. I'm not talking like 2, 3 times your money. I'm talking like the potential to get 50 times, 100 times your money, buying at really depressed levels and then selling when retail and the people who don't know as much are just chasing the price gains. The psychological aspect of this is deeply ingrained into humans. So you kind of almost have to do opposite of everyone else. It's very difficult to kind of unlearn the traits that you've learned in your younger years because most people just want to fit into the crowd. They want to invest with their buddies. They want to be a part of a group. When you do this, you're not you're going to be buying patterns. You're not going to be chasing prices. You're going to be buying things that are really low and they're creating bottoming patterns. So you're buying patterns, you're not chasing prices. And that's where normal individuals will tell you that you're crazy. And then you have to rely on the market conditions changing for the asset rotation to occur into those depressed assets. So think of it as a low inflation environment into an increasing inflationary environment. And money rotates different when the herd is subjected to those different market conditions of inflation and increasing interest rates. That's what I mean by money rotation and the market conditions in the herd being subjected to different market conditions, causing a rotation of money that is different in the market. And if you are first in that. You can also remember the movie. Um, you either cheat, be first. I can't remember the other one. You can put the other one in the comment section. I can't remember it. But what I'm doing is I'm front running money flows. I'm being first, and I've developed a strategy to identify what's cheap, what is depressed, and then I develop the cycle and see kind of where we're at in the cycle, and then I buy the bottoms. So here's another person. Just to as an example here, Gustav says, Andy, come on, be serious. We could buy Meta and Melly 2 years ago at wonderful price. No need to go to 2011 or 2012. Well, let me just show you what it's like to buy a bottom, what it feels like. All right. So I'm going to go back. You can look at my previous, some of my previous videos. Check out SM Energy that I posted in my entry point. That's just one of them. And I'm not going to nail every single bottom of all these different companies, but that's one of the ones I nailed the bottom of. So let's take a look here. So SM Energy is the orange line, and Meta is the line down here. So Meta from 2020 is up 80%. It's not too bad. SM Energy, which I purchased in where the starting point is, my return right now is 2,885%. I'm sitting on roughly a 30 bagger, 30 times my money. So, I mean, just to put that into perspective, that would be I'm at about a $420,000 position from $14,000. So that's kind of where I'm at in that one position. I have a whole bunch of other positions that are similar to this that are up over 10 times. So between 10 and 30 times, I've got maybe 12 or 13 positions since 2020, 10 positions, something like that. One just crossed here recently into a 10 bagger on my original purchase price, another one in energy service companies. So I'm absolutely decimating Meta, decimating all of these tech stocks. Actually, let's see, Nvidia might be beating me. That's probably the best, one of the best performances would be Nvidia, and Nvidia is not even close to my investments. So I'm decimating Nvidia as well. I'm not trying to brag here, but like I don't think people understand kind of what the opportunities that are in front of us, and I think eventually Nvidia and a lot of these tech stocks are going to eventually roll over due to the market conditions of increasing interest rates. So what I think is going to occur is that we're going to see precious metals, we're going to see uranium, we're going to see energy services, oil and gas, copper, a bunch of different metals, silver, platinum, all those ones that have been depressed and have been out of cycle for 2008 till today, till 2020. So 2008 to 2020-ish, somewhere in that range, we are in a consolidation downtrend. We are going to reverse. This is all going to come back up because of the 40-year downtrend that is being broken in this 40-year downtrend that's being broken in interest rates. So we went from an increasing interest rate environment to a declining interest rate environment, and that has now broken to an increasing interest rate environment. And I purchased right here at the bottom and in here of all those particular stocks in sectors, and I've been buying the entire time, cost averaging in. There's other sectors too. It's not just those that I've purchased on the website. You guys can see exactly what I'm purchasing, and I'm trying to find future SM energies, and they're out there. There are incredible opportunities in precious metals right now in the mining companies because of how depressed they are in relationship to gold itself. And it's very difficult for, I think, the majority of people to understand what I'm doing and how I'm doing it. It is somewhat complex. And I've studied this for, a good long period of time. It's not something that I just, looked at a couple of things over a weekend and just came up with. It requires a lot of emotional control, requires a lot of patience to be buying these bottoms and getting the returns that I have. And there's still a ton of different investments at this time that are at very opportune entry points. You're not gonna catch every bottom. You're not gonna catch every stock, and not every stock will be 20 or 30 bagger. But if you don't try and you don't have early entry points that have indications of bottoming in terms of technical analysis, you're never going to get them if you don't try. So the strategy and kind of what I'm doing is I allocate some portion of the portfolio to a position, and then the symmetry is what carries the portfolio higher. I won't be right on every single pick, but if I can be right on 60, 70, 80% of the picks, the symmetry is going to carry me way up. Because if you're getting 10 plus times your money on half the portfolio or greater, um, you're gonna kill it. Like it's you're gonna kill it. So what I think is coming, and we're very early in this trend, is and that's the reason I started my whole YouTube channel. I started it at the bottom of a commodity bull market. I started in August of 2020 because that's when I saw I was like, man, we're at the bottom of the commodity bull market here. We are going to crush it because of the changing market conditions that I had seen. Now I've refined my approach. I've refined some of the things that I've studied here in the past 4 years, and now I'm even more bullish on commodities and precious metals. And I still think that we are incredibly early in this move. And I'm not talking about, it just being the 10-year yield. It's the combination, and I call it the confluence of information, the gathering of all this information that points us to a particular outcome. So, I mean, just for an example, we can use COPX. So copper, this here is stage one. Stage two is where you go into an uptrend. We're just entering into an uptrend. Yeah, we could get a return move. I'm not trying to time the short term here, guys. This is a double bottom. This here is stage one with a double bottom. You break it, your ideal entry point's there. You get a flag pattern, and then we've been ripping to the upside. So I think this will, over time, continue to work its way on up. So that's copper. And then people will be like, well, that's obvious. That's totally obvious. Well, there's other sectors that are doing this as well, like GDX. This is also putting in a potential double bottom, a breakout, and then your retest was over here. So we purchased, some of this, and I purchased some in here. Or sorry, it was 2020 over here, and I rode some of this in these stocks, and I captured some 5 to 10 baggers that occurred over March of 2020 to August of 2020 when they did that money printing. That's another market condition when they print money. Gold and silver, especially the juniors, rip it. They do absolute insane things. So what I'm doing is I'm looking across all of this. I'm putting together all this information and saying, yep, commodity bull market is intact, ready to go higher. You can look at all of these things. You can look at something like URA and just do basic technical analysis, downtrend, basing pattern, and then the breakout. And we're in the beginning of the breakout. Stage one is your basing pattern. Stage two is your breakout. And this is exactly what I teach. I go into all this stuff. And that is what I think will come, is this big move higher in URA, for an example. And it's not just uranium, it's everything in commodities that are doing this. So what's the cheapest what's the cheapest sectors? Where can we get the biggest leverage? What companies outperform during what time frames? All of that stuff I go into. Now, I'm not going to get 100% perfectly, nailed to the T right. But if I get 60 or 70% of it right, and I capture the majority of the move, hey, the majority of a move of a bottom to top of a 50 or 100 bagger, if I get 20 of it, good. So that's what I'm striving to get. It doesn't mean that it will occur in a year. It occurs over time. It occurs over this big bull market that's coming, and we can price assets against each other. So I can price gold against the S&P 500. And these are things that if you look in history, you can tell like this is a double bottom. I'm just going to draw real rough here. You draw kind of a line across, or you can draw the line across here. It would probably be even better. So let me do a better line here. So we draw this line across, and what I think is occurring is a double bottom. The last bull market was from 2000 to 2011 here. This is the last bull market in a declining interest rate environment. So that was basically putting in a bottoming pattern. And this is your second bottom that's going to go all the way up, break, and then probably go up like that over time, which means we are going to have a massive outperformance of not just gold, because gold is tied to commodities. Commodities are all tied to gold. They don't want, they being the Federal Reserve, governments, they don't want gold to go up, but it's going to. And we're going to get a big revaluation higher of gold, which is going to drag the entire commodity complex with it higher. And that's why you're seeing central banks front run all this. Why they're buying so much gold before this move occurs. And that's what we're doing. That's what I'm doing. So it's all of this. That's how you tell that something's depressed. You use ratios. You look at the market conditions, and then you kind of have to dive in and figure it all out. I think I'm the closest to doing that. I don't know if other people know or have the same strategies. I think Warren Buffett might know maybe about it. Stanley Druckenmiller might know about it too. And some of these other guys might know about the business cycle, the real estate cycle, all that stuff. But there's a lot of people who don't. And that's what I just went over and trained this Saturday was on some of that. Not all of what I know. It's just, some of what I know, and it's the confluence of information and how this all stacks up is kind of what leads me to believe that this commodity bull market is coming, and we're early in the move. And that's why I go over Twitter, and there's other people that are charting things that are very similar to what I think. Now, I'm not actively going to try to find information that confirms my bias. No, no, no. I try to find anything. And I'm looking for what I would consider to be what is the most accurate way to navigate these markets. I don't care what the information is. And the information that I look at, whether it's good or bad, in terms of whether it fits my narrative or thesis or whether it goes against it, um, the thesis I think holds it's straight, like it's good. The question then is, it's not, where are we located in it in the cycle? That's really the question. Do we get another pullback before going up? And what strategies do you deploy if we do get a pullback? What does it look like? What do you do? All of those types of things. And I'm going to write through it because it's not going to be generated by the real estate market. If it is generated by the real estate market, and we do get a pullback like we did in 2008, 1929, 1974, 1980, 81, all of those were real estate crashes. All of it. And then the proceeding after it was the aftermath of credit destruction and deleveraging in the system. 1990, all of them. There are some in history that were not created, like the 2000 tech bubble. Um, the real estate market had very low inventory, about 4 months. We still had a little recession, a pullback, and it did impact commodities. And then we had the moonshot when they lowered interest rates and blew up the housing market into a big expansionary phase of real estate. Um, the fact that most people don't even know that, you should know that. Right now, what's coming, this could be driven by not just the real estate market, but also by fiscal spending and debts, which is going to be that's your big tailwind of the longer term cycle behind you. We have a couple of different things going on, and they're both in cycle at the same time. So, yeah, it's going to get real interesting here in commodities for this next for today all the way to probably um, late 2020s, early 2030s is my guess of what this is coming. So I wanted to just answer that and give you guys my opinions. And then really what I do is I use technical analysis. I look at the sectors and then I find these entry points. There's these windows of opportunities that I can enter, and you can follow what I do of these stocks, and they're really low, they're depressed, real good entry points, buy them, and then we ride it on up. There's a lot of people I think that have had great success using those entry points and learning kind of strategies, portfolio allocation of how I do things, what's risky, what's not risky, uh, you know, going into those types of things in terms of the investments, what sectors are good to enter, why are they good to enter, what does the technical analysis look like. So it kind of ties everything together, in my opinion. So I just wanted to answer kind of those questions. You can tell when something's depressed. You can tell when no one's in it. You can take early entry points. Some of the companies could go bankrupt. You should see that in the technicals, and also you can look at the balance sheets to see just how much debt they have, how bad they're struggling. You can listen to their quarterly earnings calls, which will also. I do a lot of that already for a variety of different companies in a variety of different sectors. So yeah, you can do all that, and you can kind of sift through who's going to go bankrupt and who's going to not. You can tell. So yeah, that's what I've got. That's what I wanted to share. Give me a thumb up for the content. If you guys are interested in subscribing to the website, we do have a coupon code Mayday, one word, MAYDAY, 50% off the first month only. If you want to try it out, or you can get a larger savings on a yearly membership. And you can always go from a monthly to a yearly membership if you're already a subscriber and you want a little bit further savings and you want to subscribe for a year. Up to you. We do have a question and answer session coming up next. It'd be Sunday at 5 p.m. And that's where I go over some trainings and you guys can ask me questions directly. And again, if I make a bad call or a wrong call or something, I show up. You can ask me directly and you can say, look, you made a really bad call, and I'll own up to it. But a lot of the calls I think are pretty solid if you take a long enough time frame approach. And I think a lot of people will be happy with the risk rewards that the majority of these companies can offer. So I dive into the fundamentals and the technicals, and I can kind of give you a reason why a company is good on any of the ones that I select and give the reasonings. I'm not going to give the reasoning every time just because new subscribers will come in, and I've given reasons multiple times before, but ask me during a Q&A and I can kind of run down a list and we can continue to go through the Lassonde curve, where these companies are located on it. A lot of them that I prefer are producers and stuff like that. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.